Welcome back to The Deep Dive. We're the podcast that plunges headfirst into the complex stuff so you don't have to drown in the details.
That's right.
Today we're tackling something that, honestly can feel like trying to decode an ancient scroll, but it holds the key to some real financial gain. Optimizing your tax deductions,
Absolutely critical.
especially if you're a business owner, maybe a freelancer, or even managing a savvy side hustle.
Yeah.
You know the dream, right? Legally keeping more of the money you earn.
It's the goal.
But what if there's this powerful, but yeah, often missed deduction out there, one that could significantly lower your tax bill if only you could navigate its intricate dance?
And that's exactly the mystery we're aiming to unravel today. Our focus is Form 8995A,
Right.
which is kind of the gateway to the Qualified Business Income Deduction, or, QBI, as everyone calls it.
QVI.
Yeah. And look, this isn't just about finding the right line on a form. It's really about mastering a pretty substantial tax-saving tool. It's designed specifically for individuals, estates, and trusts that have business income.
Okay.
The real power here, I think, lies in understanding the strategies underneath it all, the things that actually maximize your savings. So you can move beyond just filling out the paperwork to, actively optimizing your tax position.
Love that. Optimizing, not just complying. So, our mission for this deep dive, we're going to demystify Form 8995A, we promise.
Try.
We're going to break down its components, really item by item, and show you how understanding these seemingly small details can actually translate into substantial, tangible tax savings for you, our listener.
That's the plan.
Think of this as your personalized shortcut, your way to becoming truly well-informed on one of the most impactful, yet, let's be honest, often perplexing deductions available. Ready to dig in?
Let's do it.
All right, let's get right to it then. The QBI deduction, it seems like it popped up relatively recently, right? And caused a fair bit of head-scratching.
It certainly did, yeah.
So at its heart, what is this QBI deduction and why was it even created? What problem was it trying to solve?
That's the perfect starting point, really, because understanding where it came from makes the complexities, a bit more digestible.
Good.
So Form 8995A, yes, it's the mechanism for calculating the qualified business income deduction. And what it does, essentially, is allow eligible taxpayers to deduct up to 20% of their qualified business income.
Up to 20%, okay.
Right. And it was a direct response to the Tax Cuts and Jobs Act of 2017. You remember that?
Vaguely feels like yesterday and a lifetime ago.
Doesn't it?
Yeah.
So when corporate tax rates were significantly reduced, lawmakers basically wanted to provide a comparable tax break for owners of pass-through entities.
Oh, okay, so like sole proprietorships, partnerships, S-Corp.
Exactly, all those. To make sure they weren't really at a disadvantage compared to the big C corporations, it was kind of an effort to level the playing field, tax-wise.
Gotcha. Parity.
Pretty much. Now, the deduction itself, it has two main components that sort of work together.
Okay.
First, you've got the main QBI component. This is generally 20% of the QBI you get from your domestic trades or businesses. That's the big one for most business owners.
Right, at the core of it.
Then second, there's the Qualified Real Estate Investment Trust REIT and Publicly Traded Partnership PTP component. That handles income from those specific investment types.
Okay, REITs and PTPs, separate bucket.
Exactly. But here's the most vital limitation. And you really need to kind of engrave this in your mind for your overall tax strategy.
Right, lay it on me.
Because it sets the absolute ceiling on your potential savings. Your final QBI deduction is always capped. It's the lesser of either the combined QBI and REIT ITPTP components or 20% of your taxable income.
Lesser of the two. Got it.
And crucially, that taxable income, it's calculated before you take the QBI deduction itself.
Ah, okay.
Then you subtract any net capital gain and you add back any qualified dividends.
Okay, that's a specific calculation.
It is. And it means even if you have a massive amount of qualified business income, like tons of it, you can never deduct more than 20% of your total income from all sources. It's a critical cap. It really demands, a holistic view of your entire financial picture, not just the business part.
So definitely not a free-for-all, even if you run a super successful business. That 20% overall cap is a big deal.
Huge deal.
So given that cap, who exactly qualifies for this deduction? Is it for every single side hustler and small business out there? Or are there specific types of taxpayers who really get to play in this sandbox?
That's an excellent question. And it's where the specific rules around Form 8995A really start to define the playing field.
Okay.
The primary filers who actually compute this deduction and use Form 8995A are individuals, eligible estates, and trusts. It's designed for them.
Okay. Individuals, estates, trusts.
But there's a really crucial income threshold, and this determines which form you use, and by extension, how complex your calculation gets. This is a key area for tax planning.
Okay. Which form? That matters.
Absolutely. So for the 2024 tax year, you must use Form 89995A if your taxable income before the QBI deduction is over $383,900 if you're married filing jointly.
Okay, 383,900 MFJ.
Or over $191,950 for all other filing statuses. Single, head of household, married filing separately.
191,950 for others.
Right. It also applies if you're a patron in a specified agricultural or horticultural cooperative. They have their own unique set of rules we might touch on.
Okay, co-op patrons too.
Now, here's a really crucial distinction, and honestly, it's a great piece of practical tax-saving advice right off the bat.
Ooh, I like practical advice.
If your taxable income is below these thresholds,
Okay.
you actually use a much simpler form. It's called Form 89995, the Qualified Business Income Deduction Simplified Computation.
89995, the simpler one.
Exactly. So while we're diving deep into the complexities of 89995A today, which we are, a lot of taxpayers will actually find themselves on this simpler path, which is fantastic news if you have a less complex situation. It saves you time, effort, maybe some headaches.
That's definitely good news.
It's really important to know which form applies to you based purely on your income level.
That makes sense. A potential shortcut right there.
Yeah.
But you mentioned earlier, S corporations and partnerships, they're involved in these qualified businesses. So it seems kind of counterintuitive that they don't file Form 89995A themselves. What's the thinking behind that pass-through idea, and how does it affect the owners?
Yeah, the logic is really all in their structure as pass-through entities.
Okay.
Unlike, say, a C corporation, S Corp and partnerships generally don't pay income tax at the entity level.
Right, the owners pay.
Exactly.
Yeah.
Instead, their income, their deductions, credits, all those tax items, they just pass through directly to the owner's personal tax returns.
Got it. Like a conduit?
Precisely. So the S Corp or partnership itself, they don't file Form 89995A. They don't take the QBI deduction themselves. They just act as conduits, like you said. They provide all the necessary QBI information, income, wages, property basis, all that stuff to their shareholders or partners on Schedule K-1.
Ah, the K-1, that magic form.
That's the one. Then it's those individual shareholders or partners who take that K-1 information, aggregate it with maybe QBI from other sources they have, calculate their own deduction, and claim it on their personal Form 1040.
Okay, so the benefit flows directly to the individual owner.
That's the design, yeah. The same basic pass-through principle applies to cooperatives, too. They give the necessary info to their patrons, usually on a Form 1099 PATR or maybe a separate statement, and then the patrons figure out their deduction.
Makes sense.
Now, certain agricultural or horticultural cooperatives do have a special deduction under a different section, 199 AG, for qualified payments, but they calculate that separately. They don't use Form 8995A for that specific piece.
Okay, special co-op rule.
And then for estates and trusts, it's a bit more nuanced, but it still follows a similar logic.
Always nuanced with trusts and estates, isn't it?
Always. If a grantor or someone else is treated as owning all or part of the trust or estate, then that owner just calculates their QBI deduction as if they got the income directly. Pretty straightforward there.
Okay.
For non-grantor trusts or estates, they have an important choice. They can either claim the QBI deduction themselves for any income they actually retain.
Okay, keep it at the trust level.
Or they can pass the necessary QBI information through to their beneficiaries.
Push it out.
Right. And the allocation, how much goes to the beneficiaries versus stays with the trust, is based on the proportion of the estate's or trust's distributable net income DNI that's actually distributed versus retained.
DNI.
If there's no DNI in a year, then all the QBI items are allocated entirely to the estate or trust. There's also a specific rule for electing small business trusts, ESBTs. They have to compute the QBI deduction separately for their S corporation portion and their non-S portion. They attached an 89995A for the S part to their ESBT tax worksheet filed with Form 1041.
Wow. Okay. That's specific.
It is. So, yeah, while these entities themselves don't typically claim the deduction, they are absolutely crucial in enabling their owners or beneficiaries to claim it. They're a central piece of the tax-saving puzzle for those individuals.
Okay, this is where it gets really interesting for a lot of our listeners, I think. Understanding what actually counts. To get this deduction, you clearly need qualified business income. I mean, it's right there in the name.
Can't miss it.
So what exactly qualifies as QBI? Is it just any money a business makes, or are there like specific criteria for what actually fits the bill?
That is the 20% off your income question, isn't it?
Oh, exactly.
The baseline, like we said, is 20% of your QBI from domestic trades or businesses. But, and this is where strategic tax planning becomes really vital, that 20% isn't guaranteed.
Ah, okay. The catch.
It can be significantly reduced or even eliminated entirely, depending on your taxable income level.
Okay.
Now, if your taxable income before the QBI deduction is at or below that initial threshold we mentioned, $383,900 married filing jointly, $191,950 for others, then you're generally in the clear.
Phew.
You typically get the full 20% of your QBI without worrying too much about further reductions based on wages or property. That's kind of the sweet spot for many smaller businesses.
Right. Below the threshold, life is simpler.
Much simpler. However, if your income climbs above that initial threshold, you enter what's called the phase-in range.
The phase-in range. Okay.
For married filing jointly, this ranges between $383,900 and $483,900.
Okay. 100K range there.
And for all other returns, it's $191,950 up to $241,950.
50K range for others. Got it.
Within this range, your QBI component for each trade or business might be partially reduced.
Partially. Okay, how does that work? Well, the reduction, or rather the limitation, is determined by the greater of two amounts. Either 50% of the W-2 wages paid by that qualified trade or business,
Okay, 50% of wages.
or 25% of the W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition the UBIA of qualified property held by the business.
25% wages plus 2.5% property basis,
Okay.
whichever is greater.
Whichever is greater. Now, this is a critical limitation, but it's also a powerful tax-saving lever. Right?
So
Well, think about it. If your income is in this phase-in range, having higher W-2 wages, like paying employees more or having more employees, or having significant depreciable business property, like machinery or buildings, that can directly unlock a larger QBI deduction.
because it raises that limitation calculation.
Exactly. It means you might want to strategically think about hiring employees or maybe making significant equipment purchases if you're approaching or already inside this phase-in range, because those actions can directly impact and increase your deduction.
That's a tangible planning point right there.
Definitely. But if your income goes above the top end of the phase-in range, then the full reduction applies. Your deduction will be strictly limited by those wage and UBIA rules with no more phase-in benefit.
Okay, above the range, the limit hits hard.
Hits hard. And there's also that special reduction for patrons of agricultural or horticultural cooperatives we mentioned. Their cooperative QBI gets reduced by the lesser of 9% of the QBI allocable to qualified payments or 50% of W-2 wages allocable to those payments.
Another special rule.
So, yeah, understanding these thresholds and the mechanics of how the deduction gets limited or reduced isn't just about compliance. It's really about active tax optimization, finding ways to work within the rules to maximize your benefit.
Okay, so it's clearly not just about earning income. It's about how you earn it and what assets and payroll you have supporting that income. That makes sense. But what kind of activities or entities actually count as a qualified trade or business for this deduction? Like, for instance, does my sporadic weekend dog walking gig count? Or does it need to be more, formalized?
That's a fundamental question, yeah. Because defining qualified trade or business is really the entry point to eligibility.
Gatekeeper question.
Pretty much. Generally, a qualified trade or business includes any activity for which you can deduct ordinary and necessary business expenses under Section 162 of the Internal Revenue Code.
Section 162. Okay.
Yep.
The standard business expense rule.
That's the one. Which basically means your primary purpose for doing the activity has to be to generate income or profit.
Profit motive. Check.
And you have to be involved in the activity with continuity and regularity.
Continuity and regularity. So maybe not the sporadic dog walking?
Probably not, unless it's really a regular ongoing enterprise with a clear profit motive, like you've set it up as a proper business, you're advertising, keeping books, that kind of thing.
Okay. Needs structure.
Right. Now, for people involved in pass-through entities partnerships, S-Core, really important point, is that the determination of whether it's a trade or business, that's made at the entity level.
The business itself makes the call, not the owner individually.
Correct. You, as an individual partner or shareholder, don't make that determination for yourself regarding the entity's activity. The entity does.
Okay.
And here's something that often surprises people, and it can be a fantastic tax-saving detail.
Ooh, tell me.
Material participation under Section 469 of the Code. the rule related to passive activity losses.
Yeah, the passive loss rules. Big headache sometimes.
Right. Well, material participation is not required to qualify for the QBI deduction.
Really? So even passive investors can get this?
Potentially, yes. If the underlying business qualifies, even if you're just a passive investor in that qualifying partnership, or maybe you own a rental property that you manage very hands-off, you could still be eligible for the QBI deduction on that income.
Wow. That's huge.
It really broadens the net for who can benefit. It allows more individuals to potentially claim this deduction. That's a big aha moment for many who might otherwise assume they don't qualify because they aren't actively involved day to day.
Definitely an aha moment. But surely there are exclusions, right? Things that definitely don't count.
Oh, absolutely. There are some crucial exclusions, common pitfalls that can unexpectedly trip people up.
Okay, watch out for these.
Right. First, businesses conducted by C corporations. Never qualified trades or businesses for this deduction. They got their own tax cut.
Makes sense. C-Corp are out.
Also, performing services as an employee, strictly excluded. Any amounts reported on your Form W-2 in Box 1, that's not QBI.
No W-2 wages count. Got it.
The only tiny exception is if the statutory employee box is checked on your W-2 Box 13. Then it might count.
Okay, statutory employees are different.
They are, and there's even a tricky former employee presumption.
Ooh, what's that?
If you used to be an employee of a business and then you stop being an employee but continue providing substantially the same services, maybe as an independent contractor.
Right, change your status.
Yeah, there's a 3-year presumption that you're still providing services as an employee, at least for QBI purposes.
Wow, 3 years.
Yep. Now, you can rebut this presumption, but you need to provide clear evidence, like new contracts, partnership agreements, proof that your relationship genuinely changed and you're operating as a separate business now.
So you need documentation.
Definitely. The rule is really designed to stop people from just, converting an employee relationship into a contractor one solely to try and grab the QBI deduction.
Okay, anti-abuse rule.
Exactly. But on the flip side, there are some important inclusions that offer significant potential tax savings.
Good. Let's hear the good news.
For instance, owning and renting out real property. That can constitute a trade or business if it meets that general Section 162 standard done for income profit with continuity and regularity.
Okay, so rental properties can qualify.
They absolutely can, and this is a huge area of opportunity for many real estate investors. In fact, the IRS even issued guidance, Revenue Procedure 2019-38, which provides a specific safe harbor for rental real estate enterprises to be treated as a trade or business just for QBI purposes.
A safe harbor. Like if you meet certain criteria, you're automatically in.
Pretty much.
Yeah.
If you meet the requirements outlined in that procedure, things like maintaining separate books, spending a certain number of hours on the rental activities, then you can confidently treat your rental income as QBI. It's a practical, direct way to ensure your rental income qualifies, paving a clear path to those tax savings.
That's incredibly useful for landlords.
It is. Additionally, if you rent or license property to a commonly controlled trade or business, meaning a business, you also own a significant stake in that rental activity is explicitly considered a trade or business for QBI purposes.
Ah, renting to your own operating business.
Right. So while the rules are strict, there are also these clear pathways to qualify your business income and really unlock those deductions.
That's incredibly detailed on what actually counts as a qualified business. And yeah, it sounds like there are more opportunities than some might think, especially with rentals and passive income. Now, let's get into the real nitty-gritty. What specific dollars and cents actually make up this qualified business income? When I'm looking at my P&L, my books, what should I be tracking to make sure I'm capturing everything correctly for my QBI calculation?
Okay, this is where precision truly matters for maximizing savings. Qualified business income, or QBI, is essentially the net amount.
Net amount, okay.
Right. The net amount of qualified items of income, gain, deduction, and loss from your trades or businesses, and they have to be effectively connected with the conduct of a trade or business within the United States.
Okay, U.S.-based business activity.
Generally, yes. This includes amounts flowing through from partnerships, S corporations, your sole proprietorship, like on Schedule C, and certain estates and trusts. Basically, items that are allowed in calculating your taxable income for the year.
So stuff that hits your taxable income anyway.
Right. To figure out your total QBI for a specific business, you need to consider all the income and expense items that are properly attributable to that trade or business.
Okay. What are some common things that get included or maybe deducted?
Good question. Common items that are included in QBI, but importantly, they reduce your QBI because they are deductions, include things like unreimbursed partnership expenses.
Okay. UP.
Any deductible business interest expense, the deductible portion of your self-employment tax, that's half of it, usually.
Right.
Your self-employment health insurance deduction. And contributions you make to qualified retirement plans, like a SEP IRA or a solo 401k.
So retirement contributions reduce QBI.
They do. It's crucial to remember that these valid business deductions reduce your QBI, which in turn directly influences the final amount of your QBI deduction. So keeping meticulous records of all these business-related deductions is just as important for QBI purposes as tracking your growth income is. It all feeds the calculation.
Okay, track deductions carefully because they lower the base for the 20%.
Exactly. Now, equally important, maybe even more so for avoiding mistakes and planning effectively, are the items that are specifically not QBI.
Right. The exclusions. Let's hear them.
Okay. Income items that aren't properly includable in your gross income in the first place, out.
Makes sense.
Income that's not effectively connected with a U.S. trade or business, generally out. W-2 wages from being an employee, as we said, definitely not QBI.
W-2 wages are out. Check.
Also excluded, amounts received as reasonable compensation from an S corporation. Even though it comes from the business, the portion deemed reasonable salary isn't QBI.
Okay. Reasonable comp for S Corp owners is out.
Same for guaranteed payments from a partnership for services rendered.
Guaranteed payments out.
Also, payments made by a partner for services they provide, but not in their capacity as a partner. That's usually treated differently, not as QBI.
Okay. Specific partner payments.
Beyond that, QBI does not include items treated as capital gains or losses. Short-term or long-term, doesn't matter. Out.
No capital gains. Got it.
Dividends and dividend equivalents, also out.
Dividends out.
Interest income is tricky. It's generally not QBI unless it's properly allocable to the trade or business itself.
What does that mean, properly allocable?
Think about interest earned on your actual business operating accounts, like your main checking account needed for daily operations. That might be QBI. But interest earned on, say, excess cash reserves parked in a separate savings account or working capital investments, that's generally not considered QBI, even if those funds originally came from the business.
Okay, so investment type interest is usually out.
Usually, yeah. Also excluded income, loss, or deductions from commodities transactions, foreign currency gains or losses, or things like notional principal contracts.
More financial stuff out.
Annuities, unless they're directly related to the business somehow, out. And, as we mentioned, qualified REIT dividends and qualified PTP income. They're calculated separately as their own component of the deduction, so they are explicitly carved out of the main QBI calculation.
Right, they have their own 20% calculation.
Exactly, keep them separate.
Okay. That's a pretty comprehensive list of what's in and what's out. What about losses that are kind of stuck? Like things you couldn't deduct this year because of other rules.
Expended losses and deductions. Another critical aspect to track meticulously.
Okay.
If you have losses or deductions from a qualified trade or business that are currently on hold suspended because of other IRS rules.
Like what kind of rules?
Well, common ones are the limits on deducting business interest expense under Section 163J, or the passive activity loss rules under Section 469, or maybe basis limitations under Section 704D for partnerships, or the 1966D for S-Corp. Or the at-risk rules in Section 465, even the excess business loss limitation in 461-LI.
Okay, lots of potential reasons for losses to be stuck.
Right. If a loss or deduction is suspended by any of those rules, it is not considered a qualified loss or deduction for QBI purposes in the year it's suspended.
So it doesn't reduce your QBI in the suspension year?
Correct. Instead, it's taken into account for QBI only in the tax year when it's finally allowed to be deducted and actually used in calculating your taxable income.
So you track it until you can actually use it.
Precisely. Which means meticulous tracking of these suspended amounts is absolutely paramount. They represent potentially significant future QBI deductions or losses.
Future tax savings, basically.
Exactly. The IRS instructions even mention a QBI flowchart. It's like a structured logic path to help you methodically figure out if any given item is QBI or not.
Handy.
It emphasizes that it's not just about what number appears on your Schedule K-1 or your 1099 PAPR, your Schedule C. You still have to apply all these specific QBI rules to determine if each item is actually eligible. This detailed understanding of exactly what's in your income and expenses, that's where the true tax savings are cultivated.
Okay, this is getting really granular, but honestly, that's exactly the kind of detail we need for maximizing savings. I appreciate it.
Good. Glad it's helpful.
So shifting gears slightly.
Yeah.
What happens if your business falls into one of these dreaded specified service categories, the SSTBs?
The SSTBs.
I've heard that can feel like stepping right into a tax minefield. Is the deduction just completely off the table if you're, say, a lawyer or a doctor?
Yeah.
And kind of a related scenario, what if you own multiple businesses? Can you somehow combine them to get a better overall outcome? I've heard the term aggregation thrown around as a potentially powerful tax strategy.
Okay, you've hit on probably one of the most complex and, often anxiety-inducing aspects of the QBI deduction. The specified service trade or business rules, the SSTBs.
Minefield.
Can feel like it.
Yeah.
The general rule is indeed that SSTBs are typically excluded from the definition of a qualified trade or business if your taxable income exceeds the phase-in range.
Okay. Income is key again.
Income is key. If your business is an SSTB and your income is too high, above that $483,900 MFJ, $241,950 others threshold, then basically no QBI, no W-2 wages, and no UBIA from that specified service business are considered for your QBI deduction calculation. It's essentially rendered ineligible. Poof, gone.
Wow. Okay, that's harsh for high-income service pros.
It can be. However, and this is where it gets really interesting, a crucial aha moment and a significant tax-saving opportunity for many. There are important exceptions.
Exceptions. Good. Tell me about the exceptions.
Okay. There are basically two main ones based on income. Exception 1, full inclusion. If your taxable income before the QBI deduction is at or below that initial threshold, remember, $191,950 for most, $383,900 married filing jointly.
Right, the lower threshold.
Then, even if your business is an SSTB, it is treated as a qualified trade or business. It's fully eligible for the QBI deduction, no reduction due to being an SSTB.
So below the threshold, SSTB status doesn't hurt you.
Correct. This is a critical threshold to be acutely aware of. Falling below it can literally mean the difference between getting a large QBI deduction and getting none at all from that SSTB. It's a prime example where income planning around that threshold can pay off massively.
Huge planning point.
Well,
All right, what's exception 2?
Exception 2, partial inclusion. If your taxable income falls within the phase-in range.
That middle zone again. $191,950 to $241,950, or $383,900 and $483,900 MFJ.
Exactly. Then, an applicable percentage of your SSTB is treated as qualified. You don't get the full benefit, but you don't lose it entirely either. You get a partial deduction, and the percentage you get is proportional to how far you are into that phase-in range. Lower income in the range means a bigger percentage qualifies.
Okay, a sliding scale benefit.
Right. And to figure this out accurately, you must complete Schedule A of Form 8995A. That schedule specifically guides you through computing the exact percentage of your SSTB's QBI, W-2 wages, and UBIA that you can actually include in your overall QBI calculation. It lets you salvage a potentially significant portion of your deduction.
So Schedule A is key for SSTBs in the phase-in range.
Absolutely essential. But unfortunately, if your taxable income goes above the top of that phase-in range, $241,950,000, $483,900 MFJ, your SSTB completely loses eligibility for the QBI deduction. That's it. Done.
Ouch. Okay. Clear lines there.
Which is why high-income professionals in these fields really need particularly careful tax planning, maybe exploring strategies to manage their taxable income or business structure if possible.
Makes sense. So understanding what is an SSTB is obviously critical. Can you run through the main categories?
Definitely. The IRS instructions give a pretty exhaustive list. It covers many professional fields we often think of: health, doctors, nurses, dentists, vets, physical therapists, psychologists, and similar healthcare pros. But importantly, it excludes services not directly related to medical care. So operating a health club, processing payments, research, making drugs, or medical devices, those generally aren't SSTBs.
Okay, direct medical care.
Law, lawyers, paralegals, legal arbitrators, mediators. Again, it excludes services that don't need unique legal skills, like just printing legal docs or court reporting.
Got it.
Accounting. Accountants, enrolled agents, tax preparers, financial auditors. Pretty straightforward. Performing arts. Actors, singers, musicians, directors, even athletes in some contexts. But it excludes support services like maintaining equipment for a show or broadcasting services. Consulting. providing professional advice and counsel, including lobbying. But it excludes performing services other than advice, like actual sales or training. And it excludes consulting that's just embedded in selling a non-SSTB product if there's no separate payment for the consulting piece.
Okay, consulting is broad, but has carve-outs.
Athletics. Athletes themselves, coaches, team managers, again, excludes things like maintaining the stadium or broadcasting the game. Financial services, this one's really broad. It includes managing wealth, financial advice, retirement planning, doing business valuations, helping with mergers and acquisitions, raising capital through underwriting, acting as an agent in issuing securities. And importantly, it includes arranging lending transactions, but it excludes simply taking deposits or making loans directly, like a traditional bank might.
Okay, lots of financial activities are SSTBs.
Brokerage services. Basically arranging transactions between buyers and sellers of securities for a commission. Think stockbrokers. But it specifically excludes real estate agents or brokers and insurance agents or brokers.
Ah, good distinction for real estate and insurance folks.
Investing and investment management. Providing investing, asset management, or investment management services for a fee includes giving advice on buying, selling investments, but it excludes the direct management of real property,
Okay.
trading and dealing. This covers people who trade or deal in securities, commodities, or partnership interests as their business.
Wow, that's a lot of specific fields. What was that last one you mentioned? Something about reputation.
Ah, yes, the catch-all. This is a really broad one. Any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners.
Principal asset is reputation or skill. That
Yeah.
sounds vague. How do they define that?
Well, it's demonstrated by certain activities. Specifically, receiving fees for endorsing products or services, licensing an individual's image, name, signature, voice, trademark, etc., receiving fees for appearing at events or on media, radio, TV, video games.
Okay, so celebrities, influencers, maybe some authors or speakers?
Could be, yeah. This reputation or skill rule can potentially sweep in a wide range of individuals and businesses, maybe even ones you wouldn't immediately think of as service businesses. So it's crucial to assess if your business might inadvertently fall under this rather broad umbrella.
Definitely something to watch out for. Are there any ways out if you think you might be an SSTB? Like loopholes?
Loopholes might be strong, but yes, there are de minimis rules that offer some surprising tax-saving opportunities, even if a portion of your business involves SSTB activities.
De minimis rules. Okay, tell me more.
There are two main ones based on gross receipts. Rule 1. If your total gross receipts from a trade or business are $25 million or less for the year,
Okay, under $25 million.
and less than 10% of those gross receipts come from specified service activities, then your entire trade or business is not considered an SSTB.
Wow. So even if you do some consulting, if it's less than 10%, you're under $25, you're safe?
Correct. The whole business avoids the SSTB taint. This is fantastic for businesses that are primarily doing something else like selling goods but have a small service component.
That's a huge relief for many, I bet. What's rule 2?
Rule 2. If your gross receipts are more than $25 million,
Okay, bigger businesses?
and less than 5% of those gross receipts come from specified services, then again, your trade or business is not considered an SSTB. The threshold is just tighter for larger businesses.
Okay, 5% for the big guys. Still helpful.
These de minimis rules are really critical for hybrid businesses. They can potentially escape the SSTB classification entirely, allowing them to generate QBI eligible for the deduction regardless of the owner's taxable income level.
Great potential savings there. Is there a third rule?
Yes, there's one more related to common ownership. Rule 3, common ownership. If your non-SSTB business provides a significant amount of services or property, like 80% or more, to an SSTB, and there's 50% or more common ownership between the two businesses.
Ah, okay, providing services to an SSTB you also own.
Right. Then that portion of your non-SSTB business that provides services or property to the related SSTD is treated as a separate SSTB, but only with respect to the common owners.
Okay, prevents structuring around the rules by creating a separate support company.
Exactly. It keeps things fair. So navigating the SSTB rules requires careful analysis of your income, your business activities, your gross receipts, and even your ownership structure.
Wow, okay. That's a ton to consider just for SSTBs, and it definitely highlights the need for precise categorization of your business activities. Really appreciate you breaking that down.
Happy to. It's complex stuff.
So, shifting gears now. What if you have multiple businesses, and crucially, let's say none of them are SSTBs? Can you combine them somehow to maximize that deduction? You mentioned aggregation earlier as a potentially powerful strategy. Tell us about that.
Absolutely. And this is where aggregation of business operations, which is handled on Schedule B of Form 8995A, becomes a genuinely powerful tax-saving strategy for some taxpayers.
Schedule B for aggregation.
Okay, right. If you're involved in more than one trade or business, the general rule is that each one is considered separate when you apply those W-2 wage and UBIA limitations we talked about.
Okay, separate limits for each business, usually.
Usually. However, you may choose to aggregate or group together multiple trades or businesses into a single combined trade or business just for the purposes of applying those limitations.
Okay, you can choose to group them. Why would you want to do that? What's the advantage?
The advantage is potentially huge. By combining the QBI, the W-2 wages, and the UBIA for multiple businesses, you can often get a much more favorable result when applying those limitations. It can potentially maximize your overall QBI deduction across your entire enterprise.
Can you give an example?
Sure. Imagine you have one business, say a consulting firm, assuming it's not an SSTB for you due to income or de minimis rules, that generates high QBI but has very few W-2 employees and maybe just rents its office, so low UBIA.
Okay, high QBI, low limits.
Right. And then you also own, say, a small manufacturing business with lower QBI but a substantial payroll and maybe owns its factory and equipment, so high W-2 wages and UBIA.
Okay, low QBI, high limits.
If you keep them separate, the high QBI from the consulting firm might get severely limited by its lack of wages and property. The manufacturing firm's high wages and property might be wasted because its QBI isn't that high.
Right, mismatch.
But if you can aggregate them, you combine everything. The high wages and property basis from the manufacturing business can now help support and unlock more of the high QBI from the consulting business. You get to use the total wages and UBIA against the total QBI, allowing you to deduct more overall than you could have if they were separate.
Ah, that makes perfect sense. You leverage the strengths of each business together.
Exactly. It's about leveraging all your resources across your different ventures. But, and this is a big but, there are strict requirements for aggregation. You can't just combine any businesses you feel like.
Okay, knew there'd be rules. What are they?
There are 3 main tests you have to meet. 1, ownership test. You or a group of persons together must directly or indirectly own 50% or more of each trade or business you want to aggregate. This ownership has to exist for a majority of the tax year, including the very last day. And all the aggregated trades or businesses must use the same tax year end.
Okay, 50% common ownership, same tax year, check.
2, no SSTBs allowed. This is critical. None of the trades or businesses you wish to aggregate can be an SSTB. If even one business in your potential group is classified as an SSTB, you cannot aggregate it with non-SSTBs. You also can't aggregate multiple SSTBs together. It's a bright line rule. SSTBs stay separate for aggregation.
Okay, no SSTBs in the aggregated group.
Period.
Got it.
3, operational integration test. The trades or businesses must demonstrate they are actually integrated economically. You have to meet at least 2 out of these 3 factors. They provide products, property, or services that are the same or that are customarily offered together, like maybe a bakery and a coffee shop. They share facilities or share significant centralized business elements. Think shared personnel, accounting departments, legal services, IT resources, manufacturing processes, purchasing. HR are things that show operational unity. They are operated in coordination with or in reliance upon one or more of the other businesses in the aggregated group. This points towards a strategic, interconnected operation, not just 2 totally separate ventures.
2 out of those 3. Okay. Seems reasonable, looking for real integration.
Right. It's meant for businesses that truly operate together in some meaningful way. Now, from a practical standpoint, if a pass-through entity you invest in, like a partnership or S-corp, decides to aggregate some of its businesses on the K-1 it sends you, you must generally follow their aggregation on your Schedule B. You can't choose to separate the trades or businesses that the entity already aggregated.
Okay, stuck with the entity's aggregation.
But you can potentially add your own other trades or businesses to that RPE's aggregation if all the rules are met between your businesses and their aggregated group.
Oh, okay. You can build on their aggregation.
Essentially. And consistency is key here. Once you choose to aggregate, you have to keep reporting that same aggregation in all future years. Unless there's a significant change in facts and circumstances, that means the rules are no longer met.
Okay, stick with your choice unless something major changes.
Exactly. And you have to complete Schedule B every year to show your aggregations, including any aggregations reported to you by an RPE. If you fail to properly disclose your aggregation, The IRS might disaggregate them, which could result in a significantly lower deduction for you.
So fill out Schedule B carefully every year.
Absolutely. The impact of doing aggregation correctly when it applies can be really substantial. By combining that QBI, W-2 wages, and UBIA, you often achieve a much more favorable outcome when applying those limitations, which can directly lead to a higher maximized QBI deduction. It's a powerful tool in the toolbox if you qualify.
Okay, so we've navigated the tricky waters of defining qualified business income. We understand the pretty significant impact of being an SSTB, and now we've explored the power of aggregation with Schedule B.
Making progress.
Definitely. But even with all that figured out, the deduction still isn't just a straight 20% if your income's high enough, right?
Yeah.
You keep mentioning those other crucial limits, W-2 wages and the basis of your property. Can you tell us more about those? How exactly do those numbers play into securing that maximum possible deduction, and maybe what strategic decisions should listeners be thinking about here?
You've highlighted the crucial next layer of complexity, but it's also, as you say, a significant area for strategic tax planning. Once your taxable income gets above those thresholds we discussed, $191,950, $383,900, your QBI component for each business or aggregated group becomes subject to this wage and UBIA limitation.
Right, the limit kicks in.
Specifically, your QBI deduction attributable to that business or group is limited to the greater of two amounts, either 50% of the W-2 wages paid by the business or 25% of the W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition or UBIA of qualified property.
50% wages or on 25% wages plus 2.5% UBIA, whichever is higher.
Precisely. And this is exactly where strategic decisions around your business structure, how you manage payroll, when and what assets you acquire, all of that can be absolutely critical for maximizing your deduction. It really shifts the focus from just earning income to how you operate and what resources you're actually leveraging in the business.
Okay, so let's break down those components. How do you determine your W-2 wages for this specific limitation? What counts?
Good question. What counts? Generally, it's the total amounts paid to employees for services performed for the trade or business. This includes regular wages, salaries, bonuses. It also includes elective deferrals, things like employee contributions to a 401k plan, a 403b plan, or even certain Roth IRA contributions made through payroll.
Okay, so employee 401k contributions count towards the business's W-2 wage limit.
Yes, they do, which is helpful. Now, what doesn't count? Amounts paid to statutory employees are generally excluded if that statutory employee box is checked on their W-2 box 13.
Okay, statutory employees usually out.
Right. And if you have multiple trades or businesses, or you've aggregated them, the W-2 wages must be properly allocated to the specific trade or business that actually generated the wage expense. You can't just pool all your wages together arbitrarily.
And allocate properly.
And only the portion of wages allocable to QBI can be included. This prevents you from, say, using wages related to non-QBI income streams to boost your QBI deduction.
Makes sense. How do you actually calculate the total W-2 wage amount? Are there different ways?
Yes, there are actually 3 IRS-approved methods, and choosing the optimal one for your situation can sometimes be a direct tax-saving move.
Ooh, okay. Method choice matters. What are they?
1. Unmodified box method. This is the simplest. You just take the smaller of the total sum of amounts in box 1, wages, tips, other compensation, or the total sum of amounts in box 5, Medicare wages and tips, across all relevant employee W-2s for that business.
Okay, smaller of box 1 or box 5 totals. Easy.
Easy, but maybe not always the highest number. 2. Modified box 1 method. This one's a bit more involved, but it can sometimes yield a higher W-2 wage base, which means potentially a larger deduction. You start with the total Box 1 wages, then you subtract certain amounts included in Box 1 that aren't considered wages for federal income tax withholding purposes, like some fringe benefits. Then you add back amounts reported in Box 12 with specific codes, D, E, F, G, or S. These codes represent various types of elective deferrals and retirement contributions.
Okay, so it fine-tunes Box 1. Might be better if you have lots of those Box 12 items.
Exactly. It's often preferred if your business has significant deferred compensation plans for employees. 3. Tracking wages method. This method sums up only the amounts that are actually subject to federal income tax withholding as reported in Box 1, plus those same specific Box 12 codes, D, E, F, G, S. This method is actually required if you have a short tax year, for example, if you start or end your business mid-year.
Okay, so 3 methods. The key takeaway seems to be run the numbers for all applicable methods and see which one gives you the highest W-2 wage amount for the limitation.
That's absolutely the best practice for maximizing your deduction, yes. Assess which method works best for your specific payroll situation.
Got it. Any timing issues with W-2s?
Yeah, you generally use wages reported on Forms W-2 for the calendar year that ends with or within your tax year. So if you're a calendar year taxpayer, you use the W-2s issued for that calendar year. One little trap: amounts reported on a Form W-2 that's filed really late with the Social Security Administration, like more than 60 days after its due date, including extensions, are generally not included for QBI purposes.
Wow, okay. Don't file your W-2s super late.
Good advice generally, but especially here. There are also special rules, as you expect, for short tax years and for situations where you acquire or dispose of a trade or business mid-year. In those cases, W-2 wages are typically allocated based on the period the employees were actually employed by each employer.
Okay, allocation during transitions.
And finally, there's a crucial non-duplication rule. It prevents you from treating the same wage amounts as W-2 wages in more than one tax year, or by more than one taxpayer. Ensures the integrity of the deduction.
That's incredibly granular on wages, and yeah, it really shows how important payroll management and even just choosing the right calculation method can be for this specific deduction. Okay,
Right.
super helpful.
Good.
Now, what about the other piece of that limit, the unadjusted basis immediately after acquisition, or UBIA, of qualified property?
Yeah.
How does that factor in, and what actually counts as qualified property here?
Right, the UBIA of qualified property. This is the other crucial piece of the limitation puzzle, especially for businesses that are more capital intensive, meaning they own a lot of physical assets.
Like manufacturing, real estate.
Exactly, or construction, transportation, businesses with lots of equipment. UBIA's definition is relatively straightforward conceptually. It's the original purchase price or basis of tangible property on the date it was first placed in service by you for use in your trade or business.
Okay, original cost when you started using it.
Pretty much. Now, what counts as qualified property for this purpose? It has to be tangible property stuff you can touch, like buildings, machinery, equipment, furniture, not intangible assets like goodwill or patents.
Tangible only. Got it.
It must be subject to depreciation under Section 167. This generally means it wears out over time and is used in your trade or business to produce QBI.
Depreciable business property. Check.
It must be held by and actually used in the qualified trade or business at the close of the tax year.
Still using it at year end.
Okay. And importantly, its depreciable period must not have ended before the close of the tax year.
Ah, the depreciable period. What does that mean for QBI? Is it just the normal depreciation schedule?
Not exactly. And this is where it gets interesting and can be a pleasant surprise for taxpayers, offering a longer benefit window. The depreciable period for QBI purposes ends on the later of two dates, either 10 years after the property was first placed in service by you.
10 years, regardless of its normal depreciation life.
Correct. Or the last day of the last full year in its applicable depreciation recovery period under the normal MECRS rules, Section 168C, whichever date is later.
Okay, wait, so even if I fully depreciated, say, a piece of equipment over 5 years for my regular income tax,
Yeah.
it can still count towards my UBIA for the QBI deduction for a full 10 years from when I bought it.
Yes, that's exactly right. This means older assets, even those that are fully depreciated on your books for regular tax purposes, can still contribute valuable basis to your UBIA calculation for the QBI deduction, potentially for up to a decade. It gives you a surprisingly long window of benefit from your capital investments.
That is a fantastic nuance, huge potential impact there.
It really is. And if you make improvements to existing qualified property, those improvements are generally treated as separate qualified property with their own placed in service date and UBIA. So improvements can add to your UBIA base independently.
Okay, improvements count too. What about tricky acquisition scenarios, like trades?
Yeah, there are specific rules for those too, designed mostly to prevent artificially inflating bases. For qualified replacement property, you get in a Section 131 like-kind exchange, or through a Section 133 involuntary conversion, like replacing property destroyed in a fire.
Right.
The UBIA generally carries over from the old property you gave up or that was destroyed. It gets adjusted up or down for any additional cash or boot paid or received in the transaction. So the benefit largely continues, but you don't get a full step up just from the exchange.
Okay, carryover basis mostly.
Similarly, if you receive property in certain non-recognition transactions, common ones are forming a corporation, Section 351, or contributing property to a partnership, Section 721, the property generally retains the transferor's UBIA and original placed in service date in the hands of the new entity. Again, this prevents getting a step up into basis purely for QBI purposes just by moving property around related entities.
Maintains the integrity. Makes sense.
And there's one more key anti-abuse rule to be aware of. Property that you acquire within 60 days of the end of your tax year, and then you dispose of it within 120 days without actually using it in the trade or business for at least 45 days. That property is generally not considered qualified property for UBIA.
Prevents buying something just before year end and selling it right after, purely to goose the UBIA number.
Exactly. It stops taxpayers from simply buying and selling property around year end just to manipulate their UBIA for that brief period. You have to actually acquire it with the intent to use it in the business long term.
Got it. Real business assets.
Right. All these specific rules ensure that only genuine, sustained business assets contribute to that UBIA limit. But understanding how it works, especially that 10-year rule, makes it a powerful lever for those who plan their asset acquisition strategically, particularly for those capital-intensive businesses.
Absolutely. And just to connect back, if your income is in that phase-in range, where does this calculation happen on the form?
Yes. If your taxable income falls within that phase-in range, then Part 3 of Form 8995A is specifically designed to calculate this phase-in reduction. It walks you through comparing your potential deduction based purely on QBI versus the deduction limited by the W-2 wages in UBIA, and then figures out the applicable percentage based on where your income falls in the range.
Okay, Part 3 handles the phase-in math.
Exactly. It adds complexity, yes. But it's crucial because it allows for that partial deduction rather than an outright loss of the deduction due to the limits kicking in fully. It ensures you can still benefit, albeit partially, as your income rises through that range. Understanding these wage and UBIA mechanics isn't just about compliance. It's really about making informed, proactive decisions about hiring, about investment to maximize your tax savings.
That's a lot of intense detail, but honestly super helpful for understanding how to maybe boost those limitation numbers and truly optimize your tax situation. Really appreciate that breakdown.
Glad it helps. It's where planning meets execution.
So what about the flip side? What about losses? Can a really difficult year for the business today still somehow help me save on taxes tomorrow?
Absolutely. Losses are a critical component of the QBI calculation, and managing them correctly is actually a significant long-term tax-saving mechanism.
Yeah, how does that work?
If you find yourself with a qualified business loss from one or more of your businesses in the current year, or if you have qualified business net loss carry forwards from prior years hanging around, then completing Schedule C of Form 8995A becomes mandatory. You have to use it.
Schedule C for losses. Got it.
The primary purpose of Schedule C is to net things out. It takes your current year losses from one business and offsets the QBI from your other profitable businesses. This offsetting is done proportionally based on the relative QBI of the profitable businesses.
Okay, so losses from business A reduce the QBI from business B and C.
Exactly. This netting process can significantly reduce your current year's overall QBI, which obviously lowers your current year QBI deduction. That's the immediate impact.
Okay, reduces the current deduction. But you said long-term savings.
Yes. Here's the powerful part. The loss carry forward rule. If, after all that netting on Schedule C, you have an overall qualified business net loss for the year.
Meaning your total losses exceeded your total QBI from profitable businesses.
Precisely. That overall net loss must be carried forward to the next tax year.
Must be carried forward, okay.
This is really a foundational element for long-term tax planning because that carry forward effectively creates a future tax asset for you.
How so?
That loss carry forward amount gets used to offset positive QBI in subsequent years. And here's the real kicker. It does so regardless of whether you actually recorded the loss correctly in the prior year or even if the specific business that generated the loss is no longer in existence.
Wait, even if the business is gone, the loss carries forward?
Yes. And perhaps most importantly, this QBI loss carry forward has no expiration date.
No expiration, unlike NOLs sometimes.
Unlike some NOLs, correct? This QBI loss carry forward can potentially follow you indefinitely, offsetting future QBI until it's fully used up. This truly emphasizes its long-term power as a tax-saving tool. It means a bad year for your business today can literally translate into direct tax benefits for you years, maybe even decades down the line.
Wow. That indefinite carry forward is huge.
Yeah.
Makes tracking losses essential.
Absolutely essential. And to help with that meticulous tracking, especially with losses that were suspended under other rules before becoming QBI losses, the IRS instructions provide a practical tool, the QBI Loss Tracking Worksheet.
Okay, a worksheet for tracking.
Its purpose is to help you maintain accurate records of those losses that were suspended, like by basis limits or passive activity rules, but would be includable in QBI once they are finally allowed. When those previously suspended losses are eventually allowed in a later year, they are treated as a qualified net loss carryforward for QBI purposes. The worksheet uses a FIFO, first in, first out method. This means when you get to deduct some of those previously suspended losses, you treat the oldest suspended losses as being allowed first. It helps you allocate the allowed amount correctly between any non-QBI portion and the QBI portion of that old loss.
FIFO for suspended losses. Makes sense.
You literally track amounts across columns on the worksheet.
Yeah.
Total suspended losses, the original QBI percentage of that loss, how much was allowed this year, how much got utilized against current income, and what amount remains suspended. Keeping this accurate, ongoing record is absolutely essential for maximizing those future QBI deductions and making sure no past loss goes unutilized.
Meticulous tracking pays off down the road.
Absolutely. There are also specific rules. If a loss gets disallowed by one rule, then allowed, then disallowed by another rule, it basically re-enters the tracking process. And if an SSTB generated a loss back when you're in the phase-in range, the applicable percentage that applied to that SSTB loss back then, that percentage is fixed. It doesn't get redetermined when the loss is finally allowed and carried forward later. It simplifies things a bit for those complex cases.
Okay, locks in the SSTB percentage on the loss. Got it. Loss carryforwards are powerful future assets. Now, what about those REITs and PTPs we mentioned way back at the beginning? They're calculated separately, you said. How do they fit into the bigger picture on Part 4 of the form?
Right. The REITs and PTPs. These are crucial for certain investors who hold these types of assets, and yes, they get their own calculation, primarily handled in Part 4 of Form 8995A.
Right.
Your qualified REIT PTP component simply equals 20% of the net amount of your qualified REIT dividends plus your qualified PTP income or loss. This includes amounts you receive directly and your share flowing through from other pass-through entities like partnerships or S-Corp holding REITs or PTPs.
Okay, 20% of the net REIT TTP income. What exactly counts as qualified?
Good question. Qualified REIT dividends are generally dividends you receive from a real estate investment trust, but with some conditions. You have to have held the REIT shares for more than 45 days during a specific period around the ex-dividend date.
Holding period requirement, okay.
You can't be obligated to make related payments to someone else on substantially similar property. It can't be a capital gain dividend. Those are taxed differently. And it can't be a dividend that already qualifies for the lower qualified dividend tax rates under Section 1811.
Okay, specific type of REIT dividend.
It also includes dividends passed through from a regulated investment company or RACE, like a mutual fund, if the RAC designates them as qualified REIT dividends.
Okay, mutual fund pass-throughs count too. What about PTPs?
Qualified PTP income or loss is your share of qualified items of income, gain, deduction, and loss from a publicly traded partnership that is not treated as a corporation for federal tax purposes.
Okay, income loss from non-corporate PTPs.
This can even include gain or loss you recognize when you sell your interest in the PTP, if that gain or loss is treated as ordinary income or loss rather than capital gain or loss, which can happen due to things like depreciation recapture.
Ah, okay. Sale of PTP interest might count sometimes.
But importantly, qualified PTP income doesn't include any loss or deduction from the PTP that's disallowed in determining your overall taxable income for the year, for instance, due to passive activity loss limitations specific to PTPs.
Suspended PTP losses are out for QBI too.
Correct. And it's really important to reinforce, if the PTP itself is engaged in a specified service trade or business, SSTB,
Right.
then the income you get from that PTP might still be limited or completely excluded from your QBI deduction calculation if your overall taxable income is within or above the phase-in range, just like income from any other SSTB. The source doesn't shield it.
Okay, SSTB rules still apply to PTP income based on the owner's income. Makes sense. So before we walk through the form itself, are there any other big picture coordination issues? Like how does QBI interact with NOLs or other taxes?
Yes. A few key coordination points are vital to understand for your overall tax picture. Net operating losses, NOLs. A key point is that the QBI deduction itself generally doesn't create or increase an NOL under Section 172. It's really meant to be a deduction against positive income, not something that generates a loss you can carry back or forward to offset income in other years under the NOL rules.
Okay, QBI deduction doesn't make an NOL bigger.
Right. However, if you have an excess business loss under Section 461, that's a separate limitation that can apply to aggregate business losses. That excess loss is treated as an NOL carryforward. And when that NOL carryforward, originating from the excess business loss, is finally deducted in a subsequent year, it is taken into account for that subsequent year's QBI computation, typically as a reduction.
Okay, excess business losses interact indirectly via NOL rules.
Exactly. And here's a really common misconception we absolutely need to clear up for effective planning.
Lay it on me.
The QBI deduction does not reduce your net earnings for self-employment tax purposes.
Really? So you still pay SE tax on the full amount before the QBI deduction?
Yes. You calculate your self-employment tax on your net earnings from self-employment before considering the QBI deduction. Similarly, the QBI deduction does not reduce your net investment income for purposes of the net investment income tax, NIIT.
Wow. Okay. That's huge. QBI deduction saves income tax, but not self-employment tax or NIIT.
Correct. That's a frequently misunderstood point that can significantly impact your overall tax bill and estimated tax payments. You need to account for those taxes separately.
Definitely good to know. Anything else?
Just a quick note for some listeners. For QBI purposes, the definition of the U.S. includes Puerto Rico, specifically for taxpayers who have taxable income sourced from Puerto Rico that's subject to U.S. income tax under Section 1. And relatedly, W-2 wages include wages paid for services performed in Puerto Rico.
Okay, special Puerto Rico rule.
So yeah, understanding all these advanced scenarios, the loss management, the coordination rules, when you track it all meticulously, it really empowers you to maximize your deductions, not just this year, but potentially well into the future.
Wow. Okay, that was incredibly comprehensive. We've gone from the basics through SSTBs, aggregation limits, losses, REITs, PDPs. My head is spinning, but in a good way.
It's a lot, I know.
So with all this incredible knowledge, what does it actually mean for you, the listener, when it's finally time to sit down and fill out Form 8995A? Let's try to trace the path through the form itself, maybe emphasizing how understanding each item directly guides you to those tax savings. This is where the rubber meets the road, right?
Exactly. This is where all the planning, the strategic decisions about wages or property, the meticulous tracking of losses and income types, it all comes together into actionable steps on the form for direct tax savings.
Okay, let's walk it. Where do we start?
The first and honestly the most crucial rule for getting an accurate calculation is the order of operations.
Order of operations. Okay.
You absolutely must complete the relevant schedules first. Schedule A, B, C, and or D, depending on your situation, before you even start Part Y of the main form 8995A.
Schedules first, always. Why?
Because those schedules are specifically designed to calculate key inputs that feed directly into the main form. Schedule A figures out your allowable SSTB amounts. Schedule B calculates your aggregated totals. Schedule C nets your losses and finds your carryforward. Schedule D handles the co-op reduction. Trying to fill out the main form first would be like trying to build a house starting with the roof.
Right. You need the foundation from the schedules.
Exactly. You'll likely end up with errors or just get completely stuck if you don't do the schedules first.
Okay, noted. Schedules first. What's next?
A key number that pops up repeatedly across the form, you'll see it referenced in Part 3, Part 4, and Schedule A is your taxable income before QBI deduction.
We talked about that calculation earlier.
Right, and it's critical to get it right. It's not just your standard taxable income from the bottom line of your return. For Form 1040, 1040 SR, or 1040 NR filers, you calculate it specifically as your line 11, which is taxable income, minus your line 12, which is the QBI deduction itself.
Okay, taxable income minus QBI deduction.
For Form 1041 filers, estates and trusts, it's slightly different. Line 23, taxable income, plus line 20, the QBI deduction.
Plus, okay, different for trusts.
Yeah. Knowing this precise calculation for your specific form is a practical item-by-item detail that ensures you're applying those income thresholds and limitations correctly. Getting this number right directly impacts the accuracy and ultimately the amount of your final deduction.
Crucial input number. Got it. Okay, let's quickly recap the schedules before hitting the main form.
Good idea. Schedule A, specified service trades or businesses. You only fill this out if your business is an SSTB and your taxable income before QBI deduction falls within that specific phase and range. $191,950 is your $241,950, most $383,900, $483,900 MFJ.
Only for SSTBs in the phase-in zone.
Right. This schedule is where you meticulously calculate that applicable percentage of your SSTB's QBI, W-2 wages, and UBIA that you're allowed to include. Part 1 is for regular SSTBs. Part 2 is for SSTBs that happen to be PTPs. Doing this accurately is your direct path to salvaging a partial deduction from that SSTB, which can mean significant tax savings compared to losing the deduction entirely. Schedule B, aggregation of business operations. You use this if you choose to aggregate multiple non-SSTB trades or businesses.
If you're using that aggregation strategy.
Exactly. You list the individual businesses being aggregated, total up their QBI, W-2 wages, and UBIA into a single aggregated group figure. That combined figure then flows into Part 2 of the main form 8995A. This aggregation step, as we discussed, can be a powerful tax saver by helping you overcome those wage or UBIA limits. Schedule C, loss netting and carry forward. This one's mandatory if any of your businesses have a qualified business loss for the current year, or if you have a qualified business net loss carry forward from prior years. Remember, even unreported prior losses or losses from defunct businesses count here.
Mandatory if any losses are involved, current or prior.
Right. Schedule C carefully offsets those current year losses against QBI from your profitable businesses. It determines your net QBI for the current year, and crucially, it calculates any overall qualified business net loss that must be carried forward to the next tax year on line 6. This is vital for locking in those future tax benefits from current losses. And remember that critical rule here for accuracy. If the adjusted QBI from any single trade or business ends up being 0 or less after the loss netting on Schedule C, then its corresponding W-2 wages and UBIA must also be entered as 0 for that specific business when you get to Part 2 of the main form. You can't use wages or property from a losing business to support the deduction from a profitable one in that netting context.
Okay, 0 QBI means 0 W-2 UBIA for that line item. Got it. Schedule D. Patrons of agricultural or horticultural cooperatives. You only touch this if you are a patron of such a cooperative and you're claiming a QBI deduction related to the business you conduct with them, just for co-op patrons.
Right. This schedule applies that specific patron reduction we mentioned. Lesser of 9% of QBI from qualified payments or 50% of related W-2 wages.
Okay, schedule's done. Foundation laid. Now let's walk through the main form 8995A itself, parts I through IV.
All right, the main event. Part I, trade, business, and aggregation information. This is basically your organizational section. You list each separate qualified trade or business or each aggregated group that you have QBI from. You put the name and the EIN or your SSNITIN if it's a sole prop without an EIN. If you chose to aggregate on Schedule B, you'll enter the name you gave the group, like Aggregation 1, and check a box indicating it's an aggregation. This just sets the stage and identifies what you're calculating for.
Okay, basic info listing your business aggregations. Part 2. Determine your adjusted QBI. Now we get into the numbers. This is the core calculation section where the pieces from your records and the schedules start coming together. For each business or aggregated group listed in Part 1, you'll enter its QBI, which might have been adjusted by Schedule C loss netting, its allocable W-2 wages, and its allocable UBIA of qualified property. Okay, QBI, W-2, UBIA for each line item.
Right. It's also here that the patron reduction calculated on Schedule D gets factored in, reducing the QBI for those specific cooperative-related businesses. And remember that key rule we just hammered. If the QBI amount you're entering for any particular business or group is 0 or negative, the corresponding W-2 wages and UBIA for that same line item must also be entered as 0.
Reinforcing that 0 QBI equals 0 W-2 UBIA rule. Part 3, phased-in reduction. This part is only for taxpayers whose taxable income before QBI deduction falls within that phase-in range, the middle income zone.
Right. If your income is below the threshold or above the phase-in range, you just skip this entire section. But if you're in the phase-in range, this section calculates a precise reduction to your QBI component based on comparing your potential deduction to the wage UBIA limited amount, factoring in your income level. It determines how much the limitation actually applies to you.
Okay, handles the math if you're phasing out. Part 4, determine your QBI deduction. This is the grand finale, where your final QBI deduction amount gets calculated. Line 28. This line sums up your adjusted QBI from Part 2 after any phase-in reduction from Part 3. If this total results in an overall qualified business net loss, you enter it as a negative number here. This negative number becomes your carry forward to the next tax year, that valuable future tax asset. If it's positive, it moves forward in the calculation. Line 33. This line asks you again for that crucial number, your taxable income before QBI deduction. It's used here to calculate the overall 20% taxable income limitation. Line 34. This line requires another specific calculation we mentioned, your net capital gain, increased by any qualified dividends. For Form 1040 filers, this is generally your qualified dividends from Form 1040 Line 3A, plus your net capital gain from Schedule D. The instructions give precise line references for different forms, like 1041. This amount reduces your taxable income before applying the 20% overall limit, effectively preventing a double benefit on investment income.
Okay, subtracts cap gains dividends before the 20% overall limit. Line 39. This is it, the most satisfying line on the form. This shows your final calculated QBI deduction amount. This is the number that flows directly from Form 8995A to your main tax return, for instance, to line 13 of your Form 1040 or 1040-R. This is the number that directly reduces your taxable income and results in tangible tax savings. Line 39, the money line. Finally, line 40. This line determines if you have an overall loss when you combine your QBI component, which might be 0 or negative from line 28, with your re-ITPTP component. If this combined amount is negative, that overall loss is also carried forward to the next year to offset future QBI and re-ITPTP income.
So you see, understanding and meticulously completing each part of this form, especially doing the schedules first, accurately calculating your income and limitations, properly handling losses and aggregations, that is precisely how you unlock the full potential of this deduction. It transforms what looks like a complex, intimidating tax form into a clear roadmap for significant, actionable tax savings that can really impact your financial health, potentially for many years to come.
Wow. Okay. So what does this all mean for you, our dedicated listener? We've just taken a really, really deep dive into Form 8995A.
We sure did.
We've revealed its many, many layers of complexity, let's be honest. But crucially, I think we've also illuminated the significant opportunities for tax savings that are woven throughout its instructions and its underlying rules. This isn't just theory. We're talking about real money potentially back in your pocket.
Indeed. The qualified business income deduction, it's undeniably a powerful tool for business owners, no question. But it absolutely requires, as we've seen, careful attention to detail. Defining what constitutes qualified business income, understanding those intricate, sometimes frustrating rules around specified service trades or businesses. Strategically considering whether aggregation makes sense for your multiple operations. Meticulously tracking W-2 wages and the unadjusted basis immediately after acquisition of your qualified property, especially that 10-year rule.
Right.
And crucially, it also demands diligent management of qualified business losses, ensuring that current downturns can genuinely translate into powerful future tax benefits through those indefinite carry-forward provisions. Proactive record-keeping and a thorough understanding of these rules, they aren't just good practice, they are absolutely paramount to maximizing this deduction year after year.
And that's really what this deep dive aimed to do, to equip you, the listener, with the knowledge to either maybe confidently approach your own tax planning around QBI, or at the very least have a much more informed, much more productive conversation with your tax professional. Knowing these details, asking the right questions, understanding the levers that can truly make a tangible difference to your bottom line.
Knowledge is power, especially with taxes.
Absolutely. So, thinking about all this and considering the really extensive detail and the very specific conditions surrounding the qualified business income deduction, especially with those indefinite carry-forward provisions for losses, here's a final thought to chew on. How might a long-term business strategy fundamentally shift? Beyond just looking for annual tax savings, how can a business owner intentionally factor in these QBI rules, from hiring decisions to asset acquisition timing, maybe even how they structure deals or manage temporary losses, not just for a single tax year, but for cumulative wealth building over years, maybe even decades?
That's a fascinating question, thinking proactively, not reactively.
Exactly. Something powerful to ponder as you continue your learning journey. Until next time on The Deep Dive, keep digging deep.